Hello, everyone. Today, let's talk about the choice between fixed interest rates and variable interest rates when it comes to mortgage loans. Fixed interest rates are rates that remain unchanged for a certain period of time and are influenced by the yield on government bonds. On the other hand, variable interest rates fluctuate over time, usually in relation to inflation rates and the benchmark interest rate set by the Bank of Canada. Historically, variable interest rates have been lower than fixed interest rates for the most part. However, the current situation is such that variable rates are higher than fixed rates. Since both types of rates fluctuate and alternate between being high and low, there is a point of relative balance where they become close to equal. Following this pattern, the simplest way to choose a rate is to compare which one is currently lower and choose that. Prior to reaching the balance point, choosing the lower rate provides an advantage in terms of interest rate differentials. Let me give you an example to illustrate this. Let's assume the current variable interest rate is 6.95%, based on the bank's benchmark rate, while the fixed interest rate for a 5-year term is 4.79%. Suppose the future balance point is 4.79%. In that case, choosing the 5-year fixed rate instead of the variable rate can save you 2.16% in interest rate during the period when the variable rate drops from 6.95% to the balance point. Conversely, if the balance point is 6.95%, choosing the fixed rate can still save you 2.16% in interest rate before the fixed rate catches up to the variable rate. And the longer the time span before reaching the balance point, the more interest will be saved. Assuming adjustments are made in increments of 0.25%, this 2.16% represents 9 interest rate adjustments. The Bank of Canada adjusts rates approximately 8 times a year, so it would take a little over a year to reach the balance point. Taking into account the rising rate period and the maintenance period, even if your fixed rate is higher than the variable rate in the last year or two of a 5-year term, the average rate over the entire 5-year period would still be lower than the variable rate. Additionally, lower rates also mean lower stress test values and lower total debt service (TDS) and gross debt service (GDS) ratios, enabling you to qualify for a higher loan amount. Finally, regarding penalties, when overall interest rates are declining or stable, penalties for fixed rates are generally higher than those for variable rates. However, in cases where interest rates are rising and the fixed rate is lower than the variable rate, penalties for fixed rates may be lower, except for banks with special provisions. This is because, during such periods, the rate differential used to calculate penalties for fixed-rate loans is negative and not taken into consideration, while the portion based on 3 months' interest, which is less due to the lower rate, results in lower penalties. The chart provides examples of penalties calculated based on the rate differential for reference. I'm Mortgage Agent Jean, and I hope my explanation has been helpful to you. Thank you for watching.